Hi guys, I'm Billy To, the Regional Head of Retail Research at CGS International, and with me here is Wei Ren, our market strategist. Welcome to our briefing room today. We'll be talking about quite a few things. I think we have an geopolitical risk that shocked us during the weekend when US and Israel launched a major coordinated military campaign against Iran, with strikes targeting Iranian nuclear and military infrastructure. News have reported that the Supreme Leader Ayatollah Ali Khamenei and other senior officials have been murdered. Now, Iran has responded with ballistic missile attacks on Israel targets and US military bases across Gulf states, raising fears of broader regional escalation and instability. Right. So of course, naturally, the first few things that we have seen as market open is the increase in oil prices. I think oil prices opened up about 13%. That has moderated down to about 4% now. There's a lot of concern in terms of how geopolitical disruption, especially near the Strait of Hormuz and Gulf shipping lanes, how they will affect supply, especially for those in Southeast Asia as well as in Europe. Now, we have also seen some pullback in the markets as well. Prior to the escalation that we saw over the weekend, I think global markets have been rallying on the positive side in most markets, with the exception probably the US. We've seen quite a bit of consolidation on that front. I think we're going to highlight some of those things. So today we will talk a bit on the tactical front on how we can actually take opportunities of this news flow that has come in over the weekend. Now, one of the ways that we could really hedge the position, especially if you're already buying into the market, is really to use some of the instruments tools like the DLCs that allow you to actually hedge against the index market like the Hong Kong or the US tech markets. All right, I'm not going to talk too much on this. I'll just pass the time to Ren to share some of the tactical strategies that he has.
All right, hey, thanks Billy for getting me on board on the boarding on the briefing room again. It's an exciting time to hear you guys to talk to you guys about the market update. So, Monday, first week of the month of March 2026. I wish you all well and may you all prosper. It's still within a Chinese New Year period. All right, so every time I'll start of month, start of week, I'll look at this thing called a market breadth. So what is a market breadth? So it basically tell you about how the market advances, decliners, and then within the constitution index. So we can look at actually the Dow Jones Industrial Average has been before the war, I think up until Friday, it has grown 19% and then 11 have declined, and then out of the 11, I think the decliners has already dropped compared as of last week. All right, so this is a report format. I think if you watch this, I think the link to the report is at the description below, description box below of the YouTube channel or some other streaming platform that you have. All right. So you can see that actually you can see that the Europeans has been doing well, especially on the DAX index. I think last week the decline was way more. I think now it has increased. It has decreased to 11 and then increases on the upside. All right. Out of this, I think the Japanese index is a bit out of the balance, but overall Nikkei futures is still up on the upside again. So I'm going to share about, I think the market breadth is way before what the war has happened, but there are some tactical plays we can play around. All right, so I'm going to share first thing, the Dow Jones Industrial Average futures. All right, so the Dow futures actually this morning it gap down. It actually gap down and then has a 65%. It actually dropped 500 points according to CNBC. Not surprised because first up, I think if you read my report, I think there's a continuation link that you can read last week and the week before. I think it had reached 50,000 and then corrected down. Um, Due to the fact that momentum has been stalling, and then you can see that the long-term MACD start to turn. All right, so it turned into a bearish reversal, but you can see that selling pressure is still relatively much on the moderate side. So I won't call it a crash or a correction right now. So I agree with what Billy said early on. I think you can use DLC to position yourself, but I won't go into the short position using DLC as of right now. Why? It's because first, I think short term wise, if you are a short term risk taker kind of trader, I think you could just buy the dip. All right, where's the dip? Will be at 48,000 level. All right, and then there's a correction up to maybe 4,903 or 49,600 before correcting down the downside. So you ask where is the major support? So the major support will be around 4,500, this level 4,504, 45423, that region, before attempting to upside again. Because first of all, I think the rising wedge has already been broken down already. All right. So moving on, I think the Nasdaq futures, long term, we are still looking at the upside. Short term, rebound and then corrective structure. First up, I think you look at the wave count structure. We have one, two, three. Wave four, probably in this symmetrical triangle A, B, C, and then we have D, and then we have one more E wave. Maybe a higher low at 124,874. So if you're going to buy the dip for the Nasdaq futures, get ready that there may be a short covering at maybe there's maybe a resistance at 25822, and then before coming back down to 24938. All right, so looking at the target, I think 29,000 will be the super long term, but it's too far-fetched. We won't go into that. That is just a gauge. Like the Dow, all momentum indicators are turning. All right, so it's onto the downside. But you look at the chart, there's some discrepancy, there's some divergence. So Nasdaq at most is called range bound. So when during a range bound market, what do? You buy low, you sell high, buy low and sell high until a major trend continue to take you out on the other side. All right. Okay, I think because of the Iran issue, Strait of Hormuz, or blah blah blah, all these are coming up. Oil actually jumped this morning, jumped 7%, but you can see that it has a very sell down at the 88.6% and then close below 78.6% of the Fibonacci retracement level. So how do I calculate that? I think you can take the swing low, sorry, swing high, and then to the swing low over here, and then you can see that there's a very much sell down. So this is the price that where every people will chase, and then there will be some people just exiting the position because it's way too volatile. All right, you don't know what will happen. So M plus is a bit of overbought at this time. But long term wise, I think we are looking at a long term to the upside. First up, because if you look at the larger weekly chart of the oil, okay, 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 so you can see that from the long-term chart, you can see that from the downtrend since June 2022, it has already been broken. You can see that there's a double top, double bottom formation over here around this support level of $54 level, and then resistance level is 78.88. But I think that it's likely to break $80 over the longer term period. So right now, give it a time. I think we should see a pullback down to the downside towards maybe $67, where that's where the base support is, or even lower at 62.42 before buying on the rebound. So I'll look at light crude oil futures on this. All right. So normally the Nikkei always give us a prelude of what will happen in the US market. So Nikkei, same thing, down, and then after that was turn supported at 57,400 level, and then you can see that is attempting to close. Not a strong rebound based on daily chart, but on the hourly chart, it still look on the rebound. So for Nikkei, I think we're looking at 60,000 level as well. All right. Lastly, I think before I pass my time back to Billy on to talk more, I think there are some stocks I think many will be interested in the oil counters. All right. So you want to look at oil counters, you have ExxonMobil's CVX, Chevron, Petroleum, Petroleum, MPC, Marathon Petroleum Companies. All right. But I think OXY, I think Occidental is looking at a very, very nice level to be out. First because it really gap up, complete the higher high, higher low structure. Uptrend is in, internal uptrend structure is in, and then broke off above this $51 multiple tested resistance. All right, but I think we are looking out for a possible gap up above to 56 or 59 level before correcting. So where's the best level to buy? I would say that this will be the best level to buy at 51.57. If it would come up, it open higher and then a sell off and then correction come 49, 51 will be a good level to accumulate on weakness. All right, of course, you may just, if you don't want to miss out, I think you can just buy on the top and then let it ride. So Oxy, intermediate downtrend line since April 2024 has already been broken. But the larger corrective structure is still in. Expanding wedge. This expanding wedge is good, looking very good. Uh, as a level to as a continuation pattern to the upside again. All right, rare pattern, but powerful pattern. All right. Last but not least, I think Singapore stocks. Looking at Citron. Why Citron? Because I think corrective structure double top of this level since 2022 July to 9 October 2025 has been completed. 1:1 ratio met. Stay supported above the $2 range and then has already break up above the resistance high of $2.31. Despite the pullback down, I think we're likely to see a long-term target of 2.58 to 2.80 going forward again. All right, so I think that's all for my technical part on this.